Welcome to our latest video presentation. I'm joined by Mike Schiller, IRA consultant with Wolters Kluwer Financial Services. Mike, I understand that there are a variety of reasons for moving assets between individual retirement plans, IRAs, and between employer plans and IRAs. Will you provide an explanation of the different transactions used to move assets between these plans, and the reasons for which an individual would move retirement assets from one plan to another?
Certainly, Sue. The terminology associated with moving assets from one retirement plan to another is pretty specific to the reason for which the assets are being moved, and can be confusing. Transactions include IRA to IRA transfers, IRA to IRA rollovers, traditional IRA to Roth IRA conversions, IRA recharacterizations, and employer plan to IRA rollovers. Let me begin with an explanation of IRA to IRA transfers. Generally, the most efficient way for an individual to move IRA assets from one financial organization to another is by direct transfer. Reasons for transferring include a desire for a different investment or more convenience. When transferring assets between like IRAs, that is from a traditional IRA to another traditional IRA, or from a Roth IRA to another Roth IRA, there are no timing or frequency restrictions or reporting requirements. If a transfer is done by check, the check will ideally be made payable to the individual's IRA and include the new custodian's or trustee's name. For example, if I transfer IRA assets from ABC Financial to XYZ Savings, the check will ideally be made payable in a format similar to XYZ Savings as custodian or trustee when applicable of Mike's IRA. Because a transfer is not considered a distribution, and again, is not reportable, both the sending financial organization and the receiving financial organization are responsible for completion of the transaction. One additional item to take note of is that an individual who owns a simple IRA can transfer it to another simple IRA, or after a 2-year period of participation is met, he or she can transfer it to a traditional IRA. SIMPLE is an acronym for Savings Incentive Match Plan for Employees of Small Employers, a retirement plan which requires employer contributions to each participant's simple IRA. In the case of IRA to IRA rollovers, the rules are more restrictive because an IRA owner is given direct control of his or her IRA assets by virtue of taking an IRA distribution. As a result, the distribution must be reported to the IRS and IRA owner. Less efficient perhaps than a transfer, IRA to IRA rollovers are a common method of moving assets to another financial organization to take advantage of a different investment or for more convenience. Another reason for a rollover is to avoid tax, and when applicable, a penalty tax on amounts taken as distribution after an individual realizes the tax consequences of the distribution. To avoid income and penalty taxes on IRA assets taken as distribution, an individual must complete a rollover, a reportable contribution, no later than the 60th day after receipt of the assets. Any portion not rolled over in the 60-day period is subject to income tax and, when applicable, a 10% penalty tax. Keep in mind that the Internal Revenue Code limits the number of IRA distributions an individual is eligible to roll over during a 12-month period to 1. Regardless of the number of IRAs owned. In its publication 590, Individual Retirement Arrangements, or IRAs, the IRS indicates that this one rollover per year rule applies to each separate IRA an individual owns. However, a recent tax court decision ruled against a taxpayer using the IRS's interpretation. As a result, the IRS is changing its position to reflect the more restrictive rollover frequency limit to 1 per year per individual. Application of the IRS's revised position will take effect sometime after 2014. Now that we've talked about moving assets between like IRAs using the transfer and rollover methods, allow me to continue with an explanation of traditional IRA to Roth IRA conversions. Traditional IRAs have 2 attractive features: tax-deferred earnings and the potential to deduct regular or annual contributions. Roth IRA contributions are never tax deductible, but under the right conditions, distributions are not taxable. Furthermore, Roth IRA owners are not subject to the required minimum distribution rules when they reach age 70 and a half. To take advantage of the more attractive Roth IRA distribution rules, owners of traditional IRAs, including SEP IRAs, can convert assets to a Roth IRA. Additionally, an individual that owns a simple IRA may convert it to a Roth IRA after a 2-year period of participation in the simple has been met. The conversion process consists of both a reportable distribution from a traditional IRA or a simple IRA and a reportable conversion contribution to a Roth IRA. Conversion eligibility is not restricted by age or income. However, an individual should keep in mind that pre-tax IRA assets are subject to tax when converting. Let's move on and discuss recharacterization of a previously made IRA deposit. Through the process of recharacterization, an IRA owner can treat a contribution made to a traditional IRA as having been made to a Roth IRA, or vice versa. With recharacterization, an IRA owner can exercise a change of mind about his or her IRA contribution, or, in some situations, correct an excess contribution. An IRA owner can recharacterize an IRA contribution with the same IRA custodian or trustee where he or she made the contribution originally, or with a different IRA custodian or trustee. Additionally, an executor or other person responsible for filing a decedent's final federal income tax return may elect to recharacterize a contribution on the decedent's behalf. Though not taxable, a recharacterized contribution must include net income attributable to the contribution amount. When determining a contribution's net income, use the same calculation as that used to determine net income attributable to an IRA excess contribution when removed before the applicable deadline. The deadline for an IRA owner to recharacterize a contribution for any tax year is the due date, including extensions, of his or her federal income tax return for that year. An IRA owner that timely files his or her federal income tax return has an automatic 6-month extension to recharacterize. Using this extension will generally require an IRA owner to file an amended federal income tax return. Though not taxable, recharacterization transactions are fully reportable. The original contribution must still be reported. Distribution of the contribution being recharacterized must be reported, and the recharacterization contribution must be reported. And last, let's look at moving qualified employer plan assets to an IRA. Eligible recipients, including a plan participant, a deceased plan participant's surviving spouse beneficiary, or as the result of a qualified domestic relations order, a plan participant's former spouse, all have the option of moving eligible employer plan assets to a traditional or a Roth IRA directly or indirectly. A direct rollover takes place when eligible employer plan assets are moved directly to another plan or to an IRA. If done by check, the check will ideally be made payable to the individual's IRA and include the custodian's or trustee's name. For example, after meeting a qualifying event, if I directly roll my 401k assets to an IRA at XYZ Savings, the check will ideally be made in a format payable to XYZ Savings as custodian or trustee when applicable of Mike's IRA. An indirect rollover is similar to an IRA to IRA rollover. When an eligible recipient takes a distribution from a qualified employer plan, he or she generally has 60 days to redeposit any eligible amount to another employer plan or to an IRA as a rollover. Qualified employer plan assets can include both taxable and after-tax assets. When electing to take distribution directly from an employer plan, the pre-tax balance is subject to mandatory 20% federal income tax withholding. In any event, whether assets are moved to an IRA using the direct rollover method or the indirect rollover method, the contribution is reported as a rollover.
Thanks so much, Mike. For more information on IRA training and services, click on the link located below your video screen.